Hello and welcome back to our channel. In today's video, we'll be sharing with you 10 of the safest investments in the world. So grab a pen and paper because you'll need to take some notes. The content in this video could potentially change your life. But before we begin, have you subscribed to our channel? If not, what are you waiting for? Go ahead and also tap the subscribe button. And while you're at it, kindly give this video a thumbs up. So now, let's begin. Here's the list. Number 1. Mutual funds. A mutual fund is an investment that's managed professionally to pull or put resources together from different investors to buy securities or other purchases. By bringing money together, they're able to increase their purchasing power and diversification. A mutual fund is a good and safe investment where you can earn your money through dividends or interest rates agreed. Since they're professionally managed, they're normally popular as investors are assured of their returns. They have an option of reinvestments on your dividends, which is pulled back into your initial investment as capital. An investor will also enjoy a low risk on their investment as they are very secure. Generally, you will find that this form of investment is very convenient and accessible to many, as the initial starting amount is not high. Through diversification, a fund is able to spread its risk, which is a benefit to the investor. You need to research widely to land on the best mutual fund, which is well managed and ensures that the investments are well secured and invested in the right places. Poor management can lead to low returns for investors. 2. Treasury Bills. These are short-term investment floated by the government through the central bank. They're normally created to solely raise funds for the government. When you invest in Treasury Bills, you're actually lending to the government. They are more like non-competitive tenders, and the period of investment is normally fixed. The interest rate here is normally based on the duration of the period of the investment, as well as the amount invested. When you invest for a longer period, depending on what's allowed, you get more on your investment. When the Treasury Bills are released, you can buy them directly from the central bank's site through auctions held by the government, or if they've been in existence, that is, in the secondary market, one can buy through a broker. Treasury Bills, also known as T-bills, are safe and secure, and most investors opt for them since they know they're not likely to lose their money. Treasury Bills are very secure and may have a good tax positioning and low transaction costs. But on the flip side, they have a low rate of return on investment. This is mainly because of their short-term nature, but can be countered when you invest in huge amounts. Before moving on to the next one, I'd like to introduce you guys to one of the best finance courses on the market. It's called Money EQ by Ken Honda, also known as the Warren Buffett of Japan. The course will teach you great financial principles, and it will also teach you how to get your attitude and mindset towards money on the right track, which I believe is highly relevant, but seldom talked about. So if you can, do give it a look. I'll leave a link to the course in the description below. Number 3. Treasury Bonds. Treasury bonds are another form of government securities almost similar to Treasury Bills. They are long-term investments that pay interest periodically biannually, until they attain maturity when the principal amount is paid. This is not an ideal investment for those who want to invest for a short period of time. And since this is a way of lending to the government, investors are not taxed on the interest earned. And because they have the backing of the government, they're very safe and secure, and the investor is assured of getting the principal amount invested, as well as the interest agreed on. It's not a good idea to sell your treasury bonds before they mature, as you're likely to lose, especially if the interest rate is going up. The inflation rate is also another factor to watch when you decide to sell early if the rate rises above the interest rate you're getting. Treasury bonds are very ideal investment if you have a huge sum of money that you need to invest securely, or when you're retired and require periodic interest earnings. With bonds, you can get local tax exceptions. Although you pay income tax on interest earned, you have no fear of losses, and you're guaranteed of your payments. However, penalties apply when you redeem your bonds before they mature. 4. Certificate of Deposits. Certificate of Deposit, in short CDs, is a loan that you give to the bank for a fixed period of time. The bank will use your money and then pay you an interest which is guaranteed when the agreed loan period expires. If the loan term is longer, you'll be paid more interest. This is a good way of making use of funds you've not decided on, where or how to invest, and still grow your money. You still have the option of reinvesting your money and taking another CD when the one you have matures. Certificate of deposit is normally insured, so the risk of losing your money is eliminated. The interest rates are more on the higher side as compared to the rates given on regular savings. One of the negative aspects of the CD, like other deposits, is that your money is tied up for a given period of time, where you have no access to it. If you decide to withdraw before maturity, you'll definitely be penalized for doing so, sometimes losing some months' interest. If you're sure you might need access to your money before the duration agreed, you can decide to take a lesser interest rate where you're allowed to withdraw your money as you wish with no penalties. CDs are mostly offered by a few financial institutions, and mainly the online banks, which are accessible through the internet. 5. Fund annuities. The main investors in fund annuities are mainly people planning for or already in retirement. This fund is normally put together to address their need to invest safely and still get high returns. Investors are allowed to invest as much as they're capable of, and they enjoy tax relief based on the amount invested. They're issued by insurance companies, which should be financially stable and approved by relevant government bodies. The chances of investors losing their money are very low and depend a lot on the company issuing the annuity. Although the interest rates are low, they're generally higher than securities. The fact that you're assured of getting your returns, and the fact that most governments play a role in ensuring that funds are secure, makes fund annuities a safe investment. There's an early withdrawal penalty for this fund, as well as surrender charges if you decide to go this way. 6. Corporate bonds. These are bonds issued by large companies that are most profitable at an interest. Some may be risky, but the range is wide, with some being on the low-risk end. To be safe, the investor can invest in bonds that mature within a short period of time. You can also choose to purchase from reputable companies with a sound financial history. This will help mitigate the likelihood of a company not keeping its part of the agreement to pay the capital invested, as well as the interest. Secondly, you'll also be cushioned against fluctuations in the value of the bond due to interest rate changes. An investor must do thorough due diligence before making the investment to ensure security. Corporate bonds, however, offer better returns than bonds, and bond owners are paid earlier than stockholders in the event that a company goes bankrupt. 7. Real estate crowdfunding. In real estate crowdfunding, a company pools money together from investors to buy different variants of real estate properties or projects. This may cover residential homes or commercial buildings such as offices. The investors are allocated shares in the properties depending on the amount they invest. In real estate crowdfunding, investors can take part from any part of the world, in most cases, as their physical presence may not be needed. You will not be required to carry out any management or maintenance work on your portion of the property, as this is all done by the company. In a bid to reduce risks and ensure maximum profits, the investments are only done on properties that are strategically located and which provide consistent cash flow, or those that are profitable. The investors are paid a return on their money periodically. With proper management, this is quite a safe and secure form of investment. For an investor to get a good return, the initial capital invested should be on the higher side, as what you get is based on what you've invested. However, it all depends on each individual and available capital they have at their disposal. Real estate investments are generally secure, and the value is in most cases on an upward trend, so the likelihood of losing is very minimal. 8. High-yield savings account. A savings account may not have all the characteristics of an investment, but with a closer look, it can actually be viewed as one. The reason is that when you deposit your money in a savings account, the funds earn you interest and in turn, your money grows, even if it's at a lower percent. These accounts are completely secure, and you're not likely to lose your money. You also have access to your money anytime you need it, subject to the minimum balance limits for interest gain purposes. You also don't want to withdraw your funds all the time, as you may reduce the benefits of accrued interest, which are based on the account balance, especially when you take this as an investment. The fact that some of the accounts are insured by the governments to a certain extent ensures compensation in case the finance body for some reason fails. Though inflation can negatively impact on the purchase power of the cash, saving this way ensures your money is safe. Such an account also gives you the opportunity to increase your balance, as you can deposit whatever disposable income you get and consistently build your savings, which will, in turn, result in an increase to the interest payable. 9. Buying stocks. When you buy stocks in a company, you become a shareholder. When the company makes profits, the shareholders are paid in terms of dividends, which is calculated based on your number of shares, or your holding. It's important to note that not all companies pay dividends, but some plow back all their profits into their operations. Stocks that pay the investors in the form of dividends assure you of a steady flow of income. The chance of capital appreciation is also a possibility with dividend-yielding stocks. Before buying stocks, it's important to review the company's financial status and history of their growth path, and how steady they are when it comes to paying out dividends. Large, reputable companies, which have been in the market for some time, may serve you better and offer a safer investment for you. An investor can also invest in stocks from small but stable companies that are financially sound. The goal is to identify the right investment partners, whether large or small. You can also buy stocks from different organizations so that you can diversify and spread your risk, making your investment even more safe and secure. Well, that's it for the video. If you liked it, give it a thumbs up and subscribe if you're new to the channel. With that said, have a good one, you guys, and I'll see you in the next one.